Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
One thing that I've gotten the questions a lot about, and I'll end with, in between this and kind of talking a little more, I'll talk about kind of what's going on with the markets. But it's interesting. I've gotten a lot of questions lately about kind of, as the new administration has changed, what potential changes are going on, how that's going to affect things. And primarily in my space, we talk a lot about tax, and that's been a big topic of conversation lately, especially with now that the stimulus package is behind us. So there's some changes that are going to happen that they're honestly going to, for whether it be investments in the stock market or commercial real estate, generating income or selling real estate. All of them, there really is going to be an effect on a lot of those things, and something we need to have our eyes on and be prepared for. So, interestingly enough, three big things that are going on that are in conversation that have been brought up with this new administration that could be kind of some kind of bumps in the road for some of us that have generating income, especially kind of in retirement and looking to do that and looking to create income producing assets. There's two big things that especially. So the first is the potentially raising of capital gain rate. So right now the max capital gain rate is 20%. There's talk about moving that to 39.6%. And there's numbers. There's talk a little bit. Is that over 400,000 or is that over $1 million in income? But still, that's a 20% increase in tax on capital gains, which is something that we need to think about. On the real estate side of things, where taxes can be kind of hidden a little bit or push forward would be at a 1031 exchange. Interestingly enough, and this you guys probably know in your world, that's been talked about a lot about potentially going away. So a 1031 exchange is, for those who don't know, is potentially if you own a real estate investment piece, you could essentially shift the gain into a next piece if you were to buy another property. Well, there's talk about having that go away. So if you were to sell a building and buy another building, or sell a house, buy another house, or sell a stock and buy another stock, that's a different world. But that's 1035. But 1031, then you lose that kind of push along tax treatment, which that one I hope does not go through. Another proposal that's out there is the step up in basis for gains upon someone's passing. So right now, whether it be an asset, like a house or a building, or our world, a lot of an investment, at death, there was a step up in basis for as it passed to the next generation. Well, there's talk about that step up in basis go away, so you'd have to pay tax on that. So those are three big areas right now: capital gains potentially rising, losing of step up in basis, and potentially the 1031 exchange going away, that really kind of scare us a little bit in terms of having to really figure out some new planning strategies potentially if that were to come in effect. Now, at this point, those aren't in place, but they're definitely in the pipeline as we look about what changes have gone on with some of the new administration and some potential policies that could come to fruition. Those are three areas of tax that we're much worried about. A couple other things, kind of raising the income tax rate and things like that. Another big piece as it comes to estates. So we talk about estates. Right now, the before you get into estate tax, it's basically $11.7 million. Well, there's talk about moving that back down to about 3.5 million, which that also creates more estate planning work, or having to do trust, having to push, get assets or things out of your estate into another estate. So this says to me is, one, we got to get our estate planners ready to make sure we get the right trusts in place, and two, we got to be really aware about, before we're selling things or moving things, to make sure we know exactly the tax ramifications on any transaction that we're had. which is something we really need to be aware of. So those are a couple things that I've seen on the tax side of things that Jana, you and I talked about, maybe talk about that a little bit today. In terms of the market as a whole, in terms of the stock market, it's interesting right now. You know, it was a weird day today, kind of crept down a little bit, but we're creeping on all-time highs. And it's been an interesting last year. You know, almost a year ago today, the market started dropping down from a high down to a low, about 30% on the S&P 500. Which, you know, we went into a global pandemic. That seems very, very rational that would happen. But the rise back up was very interesting, right? I think we learned from 2008, the government did, that we weren't going to let anybody fail. So stimulus packages, right, came very quickly, which definitely helped promote, you know, quick recovery in the stock market. So the S&P 500 funny went down 30% in 1 month, but end of the year up 18%. So that's a drastic swing in a year. So where are we at today? You know, again, we just had a new stimulus package go through, which, you know, definitely prints more money into the economy. So there's something we need to talk about a little bit later. But also, you know, where can we go more up? Logically, you think now the market should start going more because the fact that the markets are, you know, the economy should start opening right now. That's where we're kind of at. But you know, fear, you know, there's some fear creeping in right now. So we don't see any sort of huge pullback right now, but, you know, on average, since 1980, the market has dropped from its starting point to the ending point at least 14% each, you know, on average, you know, one time per year or so. So there's a lot of, there's potential out there. You know, does the stimulus and the opening of the economy outweigh kind of some fear and the potential of what's going on? Hard to say, but I think in the short term, you know, we're definitely going to keep our eyes open to what's going on, especially because the market has recovered so well and is in such a good spot. Jana, what in terms of the new administration kind of policies and such, does that help answer some of the questions that you and I talked about?
Yeah, that's great. So really, I think probably consumer confidence is so important in both your world and in my world.
Yeah.
And maybe you can talk a little bit about the key economic indicators that economists are looking and that you watch, because I know you have you have access to a lot of expert advice. And you're talking about the 10-year treasury and talking about, for example, durable goods and all those kinds of things. I think for us, at least, the irony is that you wouldn't think durable goods would have that big of an effect on commercial real estate. But the problem is that if you can't get the things to be able to construct the buildings, you know, you're talking about simple things like appliances, et cetera. How are those kinds of things like COVID, what are you seeing how are those affecting the market right now?
Yeah, that's interesting. I think, you know, when we're, you know, one interesting part of the market right now as it pertains to kind of what's going on is look at kind of the sectors, you know, for instance, when we look at the S&P, the different sectors and the different business types. So we think about technology, and last year, you know, technology has really had a great run, especially growth companies have done really, really well. There's other sectors, you know, so growth has done really, really well. And what's actually done better this year has been value. And then there's value companies, these kind of computer super staples, dividend payers. Because one of the big things that we constantly look at in our world is, you know, we're looking at earnings. We're looking at earnings season with companies. We're saying, are companies making money? Because when we come back, that's a big indicator for us, is to say, how are things going? We had a couple years back when there was a lot of talk on the news that said, you know, companies' earnings are only up, you know, 8% over last year, where last year they were up 15% or something, and that was bad news. But it was funny to us, we were saying, well, that's not bad nenews. They're growing. That's what we want them to do. So that could even be interesting. But we look a lot at companies and earnings, because when we come, the nitty gritty of what we talk about with fear about what's going on with the market, what's going to happen, is we think about the fact that are companies making money, and are they able to make money, right? So we look at, you know, kind of different sectors, like oil and gas right now. That's an interesting space with kind of new administration. What's gonna happen with that area? You look at Biden has been very focused on manufacturing and then kind of creating jobs in that way. Does that area come into play? So we're really focused on kind of job numbers, really looking at that, and those have been okay. That kind of, and then we're looking at unemployment, and we're also looking at company earnings. Those are three big things that I kind of follow pretty religiously to kind of understand, okay, what's the sentiment and what's going on, as opposed to kind of listening to listening to the talking heads say when's the market going to crash.
That's wonderful. Keep going.
So I think one part about, I think, that correlates what I do with investment management and wealth planning kind of on the investment side and kind of what Janet and Brian do at the Accel group is we're constantly looking at a plan. And the interesting part is plans actually coincide as opposed to are different. Janet and I talk a lot about the fact that clients, an ideal client would be diversified not only in what they own, but also in kind of what type of buckets they had to kind of build, grow, and maintain wealth. So I think about, we're encouraging folks to have a good mix, to not have all their eggs in the investment bucket, or not have all their eggs in the, real estate bucket, or have all their eggs in the Bitcoin bucket, whatever that bucket might be. We're talking about not only being diversified within that specific bucket, but also having multiple buckets. And so, and all with the idea of minimizing taxes and minimizing risk. I think that's all of what we're trying to do, is we're trying to push taxes along, try to minimize what we pay. We're trying to mitigate the risk that we take. And so when I'm talking to a client about their overall plan, we're talking about, okay, what's the best way to get you to where you need to go? And what are those goals? We're talking a lot about legacy, and we're talking about how do you get to that point, and strategize to be able to pass on to the next generation, but else live comfortably so you don't ever have to worry about money. So on our point of view, what we're talking to folks about is having, doing the right things within the investment approach to get the return needed for their goals. Oftentimes, when we talk to a client, that sometimes they say, well, what are you looking for, in your investments to return? It's as much as we can. Well, that's to us, that takes too much risk. So we're talking about how do we get the right risk-adjusted return, and what do we invest in to get you there? On our end, what we're focusing a lot to help the overall plan is we really do a lot of tax planning with folks within their investment portfolios. We talk a lot about donor advised funds. And so what donor advised funds, essentially basically creating family foundations or gifting appreciated assets into a foundation, getting the tax deduction that year, and then be able to manage those funds to be able to give later. We talk a lot about giving and a lot about how, being able to have, setting up these things called donor advised fund can help not only tax entry year, but also, fill your philanthropic needs and also your giving needs. We talk a lot about, converting as much as we can from pre-tax money to after-tax money, should be the right situation be in play. And we do talk a lot about, gifting appreciated assets. That's a big piece to the pie. When we talk to a lot of new clients, typically they have a lot of built up tax in some vicinity, whether it be in a big 401k or IRA that they built up over years, or whether it be in, a building or a real estate, investment that they've owned for a long period of time. And how do we, get that to the next point and get the most tax efficient way possible? So we deal a lot with CPAs directly. We meet with client CPAs to try and manage to help them get to where they need to go. And we also deal a lot with estate planning. There's in Tennessee, we've got some very unique trusts that can help folks kind of get assets out of their estate and protect those assets. It's things like asset protection trusts and Tennessee community property trusts. There's different trusts that can be presented that you can put assets in to help protect from different variables. And so those are things we walk through clients with. All with the goal of having a long-term plan. We keep coming back to the word plan. I know that seems cliche, but in our eyes, if that's always the focus. I use this too much, but I think about if someone were to have a weight loss goal, the first thing that you'd ask yourself is, what do you want to weigh? I said, why are you eating different, or what are you doing? Well, if you don't know what you want to weigh, then the plan is different. Then you don't have a plan, and then you just, working out or doing something for nothing, and then typically you'll burn out and quit doing that. It won't become a habit. So we go back to the end goal. How do we get you there all along the way? I think the third big thing, kind of on different topics, that is on my horizon a lot right now is these tax and estate planning changes that are coming up. I think that's a big thing in all of our industries that we need to be aware of. But then secondly, inflation is something I think we need to be pretty aware of coming up. I mean, we've printed a lot of money, and inevitably inflation is going to be something that hits hard, and we don't know when or where. So and to us, that tells us we need to keep growing assets. We need to figure out how to continue to generate income and grow wealth, so that because down the road, that Starbucks coffee that costs $5 today is probably going to cost $10 down the road, and we're going to be the ones saying, "You remember when coffee cost that much?" So those are two big things on my horizon that we're talking to clients a lot about, is making sure we have a plan to mitigate those couple things, and continue to monitor those things to make sure that we're going to give the really best advice.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.